Good morning, everybody. My name is Brian Cantrell. I'm the Senior Vice President and Chief Financial Officer of Alliance Resource Partners. This is the first time we've attended a Noble conference, and I want to thank them and our new covering analyst with Noble, Mark Reichman, for letting us come today to share our story. For those of you who may not know a lot about Alliance, we are a master limited partnership, have been traded on NASDAQ since 2009. And for nearly 3 decades, we have been, I'm sorry, it was 1999, I apologize for that. We have been providing low-cost, reliable energy primarily through fossil fuels. We are the second largest coal producer in the eastern U.S. And back in 2014, we also began investing in the oil and gas mineral space and have grown that part of our business to a fairly substantial size as well. As we look forward, we recognize that there's an energy transition going on. We know that our businesses are generating significant cash flows, and we are looking to reinvest those cash flows into new platforms for businesses in the fast-growing energy and infrastructure transition business. Over the years, we have demonstrated a very disciplined approach to our financials, also focusing on returning cash to our unit holders. Over the last 14 years, we've returned about $3.2 billion in total distributions to our shareholders. We have generated strong positive cash flow throughout the commodity cycles. Obviously, coal and oil and gas are commodities and they do cycle, but we have been profitable throughout these various cycles and have generated cash flows every year. We try to manage our balance sheet very conservatively. At the end of last year, our net debt was at 0.7 times. We brought debt down quite a bit during 2020 as everybody was trying to adjust to the COVID implications, and we've continued to show that discipline throughout. So what I want to do now is talk about who we are today and where our cash flow generations come from, and then focus a little bit more on what we see for our future. On this slide, you can see where our active assets are. We do operate 7 mining complexes in the Illinois Basin and Appalachia. As I mentioned, we are the second largest coal producer in the eastern U.S. Last year, we produced approximately 32 million tons, and we're planning to grow that this year as well. Our minerals segment, since 2014, and I just want to touch a bit on how we approach that. We knew our coal assets were throwing off significant cash flows, and we wanted to see if we could develop new business platforms that could utilize those cash flows for future growth of the organization. When we first got into the minerals business, we took a walk before you run approach. Initially invested as a limited partner in some asset acquisition companies. We studied that for a couple of years, determined that we could use that as a platform where we could manage it actively. And since we initially got involved in it, we have now invested over $500 million in the oil and gas minerals. Today, we own about almost 57,000 net royalty acres. That acreage is focused primarily in the Permian Basin, where it's predominant. We also have a very strong position in Anadarko, in Oklahoma, the Scoop, Stack, Merge, Edge, those types of fields. And we have a nice position in the Williston as well. We also have about 5 to 6% of our net royalty acres are in the Appalachian region, Marcellus and Utica. That's not currently an area of focus for us, but they are generating very strong cash flows. So we plan to stay in that arena. This slide shows what I was talking about in terms of the strong cash flow generation throughout various commodity cycles. You can see here that we've generated free cash flow every year. In particular, I want to focus on the results in 2020 and 2021. As we know, in March of 2020, the COVID implications became very real. We were looking at how we should manage through that, as was every other company, frankly. We were looking for ways to optimize and reduce our expenses, our CapEx, and our cash flows. while we still made sure that we could serve our customers and protect the safety of our employees and the communities where they work. We did idle a few of our operations as part of that effort for a period of time, but only where we could supply the requirements of our utility customers out of existing inventories. Remember, power is a very essential sector. I'd like to say when Governor Cuomo at the time was screaming for all the ventilators he could get, if he got them and the power didn't come on, it really didn't matter. So we were very, very focused on making sure that our customers could continue to deliver low-cost, reliable power to their customer base. As we worked through that, and once we restarted our operations across the board, the performance was really pretty astounding. We reduced our total debt by about $197 million during the 2020 calendar year, increased our liquidity by $220 million, and generated approximately $280 million in free cash flow. Turning now to our performance and our initial guidance for 2022, let me take a minute to first talk about the performance in 2021 and how that compared to 2020 as we were coming off of that very challenging year. As I mentioned, we sold about 32 million tons. That was an increase of over 14% compared to 2019. Compared to 2020. Our revenue jumped over 18%. EBITDA increased nearly 24%. And net income was up by $150 million over the prior year. Free cash flow generation last year was $302 million. We further brought down debt by another $162 million. And as I mentioned earlier, reduced our net leverage to 0.7 times at the end of 2021. You can see over on the right-hand side what our initial guidance is for 2022. Coal sales are expected to go up 9 to 14% over 2020 levels. We currently, or at the end of the year, we had about 89% of our expected production in 2022 already priced and committed. And I want to talk a little bit about the commodity environment that's transpired heading into 2022 and since then. But you can see with our initial guidance, our expected realization on a per ton basis was up at that time 14 to 19%. Costs also went up. We are managing through inflationary pressures, labor shortages, supply chain challenges, et cetera. So you would anticipate costs increasing, and we have reflected that here. I want to talk about how the commodity market developed. Beginning in the middle of last year, as you all are probably aware, we saw a very significant increase in natural gas pricing. And over the second half of the year, that was leading to increased pricing for both domestic and international coal. Heading into the year, you can see that we expected our revenues to increase by that 14 to 19% range on a per ton basis. I can tell you that the guidance that we had in place at the end of January when we first released this does not reflect the continued strengthening of the energy markets around the world. Obviously, the unfortunate situation in Ukraine has had a big impact on that. Frankly, the global community is trying to figure out how to wean themselves off Russian coal and natural gas. That has led to a shortage, systemic shortage in those products around the world. Gas pricing has continued to escalate. I believe yesterday it closed at about $6.94, I think, almost $7. And when you look out into a year from now, calendar year 23, it's still in excess of $5. At those prices, coal is absolutely very competitive on a dispatch basis. It's cheaper to generate power from coal than it is from natural gas. And as a result, you continue to see the pricing for coal increase very significantly. I think yesterday, Illinois Basin product, where much of our production comes from, for May deliveries closed at $133 a ton. Calendar year 23, you're seeing over $80 a ton. Our Northern Appalachian product closed at $130. calendar year 23 is at 80. And most importantly, the international markets are just incredibly strong as Europe and other parts of the world are trying to figure out how they manage their supply needs in light of the situation in Russia. API 2 pricing, which is the market we sell into predominantly, closed yesterday for May deliveries at $325 a ton for thermal product, and calendar year 2023 is still very, very strong at $246 a ton. So what you are seeing is most producers in the U.S. are definitely in an allocation mode. Production can increase in some cases, but it's fairly limited. We're one of the few companies that can actually increase production and stay within our installed capacity on infrastructure. Given the underinvestment challenges that some have faced in the financial markets, the unwillingness of capital to support fossil fuels generally has definitely impacted the ability of the coal producer in the U.S. and frankly globally to respond to this significant increase in demand. In the U.S., utilities began finding themselves in a bind. Stockpiles had dropped down to less than 20 days at most of our customers. I'm aware of one unit that had stockpiles at less than a week. That was because they were focused on natural gas, not really building up their stockpiles to provide a buffer, if you will, during very cold winters and hot summers that we're coming into. And they assumed that the production would just be able to respond and they could act as they have been doing over the last 5, 6, 7 years. That production did not come on for the reasons I mentioned earlier, and they found themselves in that critically low stockpile position. To put that in comparison, it varies by unit, varies by utility, but most utilities like to see, call it 45 to 60 days of inventory on the ground so that they can manage their fleet as efficiently as possible. Getting down to 20, getting down to a week is a very challenging situation for them. They typically use this time of year to rebuild their stockpiles in the U.S. Unfortunately, for the fuel buyer today, the international markets are so strong that they're having a lot of difficulty getting producers like us to allocate tons to them. So what you are seeing now is a bit of a change in the discussions and the narrative with producers and utilities. Because of low price natural gas for such an extended period of time, most utilities had gone to a very short-term buying practice, quarter to quarter, semi-annually, on an annual basis, again assuming that if the need was there, the producer would be there for them. Given all of the factors that have played out now, they are beginning to understand the critical nature of reliable supply from financially viable, reliable producers. And so we are beginning to see conversations again for longer term agreements. The contracting that we've been doing since our January initial guidance reflects that. You're also seeing a bit of a move on that on the international side. Internationally, the U.S. has been a swing producer, typically selling at times vessel to vessel or maybe quarter by quarter. Even some European utilities are beginning to look to us and say, should we enter into a longer term agreement so that you provide us a base load of reliable supply for several years. Still in a lot of discussions, but it just points to the fact that given the unfortunate situation in Europe right now, reliability of long-term supply is becoming more and more critical. So this slide is really just a summary on the foundation for item 1 and 2, our coal business and our minerals platform. And then item 3 shows where we plan to go in the future. And I'd like to touch on that a little bit more. People ask us, you're primarily a fossil fuel company. You're very good at mining, extraction, processing, transportation, logistics. How do you plan to move into areas that are outside of what would be your core competencies? This chart shows exactly how we plan to utilize our capital to do that. Looking at the bottom platform for our minerals, our intention is there's plenty of opportunity to invest in minerals across the country. and we are planning to utilize the free cash flow within our minerals platform to reinvest that back into growing that part of our business. At current run rates, that's probably in the neighborhood of $100 million a year or so. Doesn't mean that we'll necessarily invest $100 million, evenly every year. You have to be responsive to the market, and you have to be competitive in the market. We maintain very strict underwriting discipline in terms of how we will invest and what types of returns that we find acceptable. With the current price environment, as you might imagine, the spread between the bid and the ask on royalty assets can be fairly wide. We will not chase those deals just for the sake of putting capital to work if it doesn't make economic sense to us, but we are actively engaged in evaluating numerous opportunities, both from a package standpoint and working with partners from a ground game, meaning that they can go out and talk directly to the landowner, the ranchers, the farmers that own the surface and utilize the surface, and they also own the minerals underneath that. So our coal platform, we now plan to use primarily for those cash flows to be deployed into areas outside of coal and oil and gas. We're principally focused on energy and infrastructure transition. And you might wonder, well, how can you guys participate in that? What skill sets do you bring to the table that will allow that to happen? This slide shows the areas that we're really focused on. The electrification area, building infrastructure for EVs and EV charging, battery metals. As I mentioned, we're very good at extraction, processing, logistics, and transportation. So we're evaluating potential opportunities to play in the battery mineral space, either through royalties or processing. That's really just a one-off derivative from what our core competencies are today, and that is an area that we're focused on. And then in addition, we're looking at opportunities to utilize what would otherwise be assets that aren't cash flowing, and can we convert those assets into a cash flow vehicle. As utilities begin to build out in our areas, solar farms, they need surface acreage. We have plenty of surface acreage around our existing mining operations. Those operations are close to existing transmission systems, and we hope to be able to work with our utility customers to leverage those assets into participating in some way in development of solar projects that is attractive to us from an economic standpoint and can actually generate cash flows. As we've been studying this for some time now, and it's been pretty interesting. I'm sure you're aware there's a lot of capital chasing this type of activity. The challenge that we've had is we're interested in pursuing it if we feel like it can be in the form of a sustainable, cash flowing, profitable business that generates an attractive return to us. It's been challenging to find those things that might work. You're seeing companies that are valued on double-digit multiples off of revenue. They're not profitable. There's still technology risk involved. We're trying to avoid just chasing the current bright shiny thing and following the pack. We're really looking to how can we leverage our customer relationships in the communities, our strong relationships at the federal and state governmental levels, and utilize the skill sets that are existing within our company today to leverage those in other ways. A primary way that we're doing that is with our subsidiary called the Matrix Design Group. Matrix was a company we started in 2006, and it's been embedded within our organization since then. Their initial charge was really to develop hardware, software, data analytics, and artificial intelligence to develop solutions for the mining sector to enhance safety and productivity. They have successfully developed technologies that are now deployed globally. We have a small office in South Africa that we sell our products to the South African mining markets. We're looking at other areas around the globe where our products could be useful. And we think that we can utilize the technological and manufacturing expertise of the Matrix Group to enhance our opportunity to participate in a way where we can add value to the energy and infrastructure transition, and we can actually make money on a sustainable basis. So that's who we are. This is where we hope we're headed, and I would be happy to answer any questions that you all might have. Yes, sir.
Some people are saying now with the increase in commodity prices that we're entering a new super cycle in commodities. Do you look at it?
The question, to make sure everybody heard it, was, it looks like with the run-up in pricing, and please correct me if I misstate your question, we may be entering a new super cycle that was talked about probably 5 or 6 years ago, and do we agree with that? I think as you look at the current supply-demand fundamentals around the world, because of the lack of capital investment and support in coal, oil, and natural gas that has developed over the years, the caution that people are taking to want to make sure that they are utilizing, living within their own cash flows, if you will, and not looking to lever up as they have historically done. That points to, in my view, that pricing is going to remain higher for longer. Whether you define that as a super cycle or not, I don't know. I've had some people ask, well, when hopefully the situation in the Ukraine is resolved, do you believe that you'll see a sharp correction and that the markets will respond in that way? I think initially there's a chance that you could see a knee-jerk type reaction that, okay, the situation's resolved and things will return back to normal. But when you listen to countries in Europe saying, no, these are long-term areas where we are not going to put ourselves in the position where we have to rely on Putin's good graces, that the flow of Russian energy supplies around the world, for that to return to a normalized situation, I think will take some time. So the curves are definitely backwardated, no question about it. So you may be seeing some short-term reactions just given the critical nature of what's happening today. But at $5 plus nat gas, coal is going to continue to be a very important part of the power generation, both in the U.S. and globally.
However, with the present administration, they will not encourage coal.
Clearly, there's been pressure on the coal sector. ESG pressures are real. There's no question about that. But we are seeing that our customers, who have always known the importance of having this baseload reliable power, the importance of that is just becoming clearer. And again, you're beginning to see countries beginning to rethink some of the policies that they put in place over the last 10, 15 years that are having very significant real-world impacts today. And I think I'm about out of time. May be able to answer one more question. Mark? Yeah, the question Mark asked is, with increasing cash flows, how are we thinking about returning cash to unit holders? We did increase the distribution fairly substantially at the end of last year. We are in the middle, frankly, of revising our current 5-year forecast, and we will see increasing cash flows around that. We're meeting with our board next Monday and Tuesday, and I believe you'll see conversations around what is the proper current distribution level that we think is sustainable, and how do we view the ability to increase distributions as our cash flows continue to be very, very strong. And with that, I think I am out of time. Appreciate everybody attending. Thank you.